Good afternoon, it's Gene Inger. This is the pre-close comment with about 30 minutes left in market action to our IngerLetter.com MarketCast members. And certainly here we have a dramatic rally. We called for the down-up-down pattern and then question mark. We knew they were going to bring this market back into the 2 o'clock balloon, sell it off again. Then, of course, what you got was a dramatic short covering rally. This rally we've had today, and which has us long now because of the parameters that we gave, nevertheless, it is a little bit different than what we maybe originally had in mind. But I think when you see the scenarios, such as the game of chicken being played by Citigroup, the Enron style credit and off-balance sheet aspects that are still going to come to haunt us. And you wonder, well, why are these stocks and retail moving up while the technology stocks are going down very much as we expected, whether it's Google from 700, which we said you had to be insane to buy, or likewise Apple at 200 insanity. What the reality is that they've shifted money into the rearranging of the Titanic deck chairs in a way that would give an advertised rally in the big cap, market capitalization weighted stocks to give at least the illusion of strength, even if it isn't broad. And what that's done is it has triggered a short covering rush just about everywhere from those who shorted into weakness, which is something we certainly were against. We hold our 1595 macro short sale in the S&P March adjusted against the backdrop of being long at the moment for this rebound, which may or may not be a plunge protection team kind of situation, and if you want to call it that. And at the same time, I think there's concern about the European banks as we open on Thursday, so they want to put in this rally here in hopes that will mitigate any big declines over there, and nobody's talking about what's going on really in the commodities markets. So as we look at the backdrop of this against a daily basis S&P chart, you can see the low, today's low, which essentially on an intraday basis is a secondary test of the previous low and turns up our daily basis stochastics readings and so on. It does not necessarily, however, change anything with respect to the weekly basis, which we're looking at here, but, well, it too has turned up. If this is nothing more than a run-of-the-mind correction, then you have the possibilities that, this is it as far as a low. What do I think the odds are? I'll explore that tonight. I think our IngerLetter.com members know my views on that. I'll explore it a little bit more, and I think there's a lot more work to be done. I think you'll make, as I've said before, a rotational bottom in different stocks at different times. Do I think the ultimate lows have been put in general for a majority of stocks? And the answer is no. But certainly risk, as I've said for a week now, has diminished as stocks move lower. And that sets us up for month-end activity. It sets us up for Hail Mary rebounds. And if those rebounds fail and then you start going to lower lows, that's when gut-wrenching panic can materialize. Currently, the Dow Industrial Average is up 197 points. And we're not going to try to look at a weekly chart there. Well, there it is. And you can see a very, very similar situation to that of the S&P. There's your intraday Dow. Rather, their daily Dow, and there is your intraday Dow Industrials, currently up just around 200 points. So we'll leave it at that. We'll stay long. We'll trail a 3-point stop and exit for the day, which becomes a 2-pointer 10 minutes before the bell or on close, and we'll leave it at that pending my comments this evening. Good afternoon.